What is a long call calendar spread? Step-by-step implementation process. The strategy focuses on profiting from time decay differentials between short and long-term options while managing volatility exposure. Key profit drivers include theta decay from the short leg expiring worthless, while the long leg retains value, making it ideal for sideways moving cryptocurrency markets. Would you like me to elaborate on any specific aspect of the strategy or add information about particular cryptocurrency exchanges that offer options trading in the USA? A long call calendar spread, also known as a call horizontal spread, involves simultaneously selling a short-term call option while buying a longer-term call option with the same strike price. This strategy profits from time decay differential and changes in implied volatility between the two expiration dates. Step 1. Market analysis and setup preparation. Begin by analyzing the cryptocurrency market conditions. Identify a cryptocurrency with moderate volatility expectations and upcoming events that might affect price movement. Bitcoin BTC and Ethereum ETH are popular choices due to their liquid options markets. Access a regulated U.S. exchange that offers cryptocurrency options, such as LedgerX, FTX US before closure, or institutional platforms like Bakkt. Step 2. Strike price selection. Choose an at-the-money ATM or slightly out-of-the-money OTM strike price. For example, if Bitcoin is trading at $30,000, select a $30,000 or $30,500 strike price. The strike price should be where you expect the underlying cryptocurrency to trade near the short option's expiration. This positioning maximizes the strategy's profit potential. Step 3. Expiration date selection. Select two expiration dates with optimal time decay differential. Sell a call option expiring in 2-4 weeks short leg, and buy a call option expiring in 6-12 weeks long leg. The time difference should be sufficient to capture meaningful theta decay while maintaining positive gamma exposure. For instance, sell a 30-day BTC $30,000 call and buy a 90-day BTC $30,000 call. Step 4. Execute the trade setup. Simultaneously execute both legs of the trade. Sell the short-term call option first to collect premium, then immediately buy the longer-term call option. Ensure both orders are filled at favorable prices to establish the spread for a net debit. The net cost represents your maximum risk in the position. Step 5. Position monitoring. Week 1-2. Monitor the underlying cryptocurrency's price movement relative to your strike price. The ideal scenario involves the price remaining close to the strike price, while implied volatility increases for the long leg and decreases for the short leg. Track daily theta decay, which should favor your position as the short option loses value faster than the long option. Step 6. Managing volatility changes. Watch for changes in implied volatility between the two legs. If volatility increases significantly, the long option gains more value than the short option loses, benefiting your position. Conversely, if volatility crushes occur, consider closing the position early to minimize losses. Volatility skew between expiration dates can create additional profit opportunities. Step 7. Short option expiration management. As the short option approaches expiration, several scenarios may develop. If the cryptocurrency price is below the strike price, the short option expires worthless, providing maximum benefit from time decay. If the price is above the strike, you may face assignment risk and need to manage the position actively. Step 8. Profit taking at optimal timing. The maximum profit typically occurs when the short option expires worthless, while the long option retains significant time value. This usually happens 1 to 5 days before the short option's expiration, when the underlying price is near the strike price. Calculate the position's value daily and consider taking profits when you've captured 50 to 75% of the maximum potential gain. Step 9. Risk management protocols. Establish stop-loss levels at 150 to 200% of the initial debit paid. If the underlying cryptocurrency moves significantly away from the strike price, the position may become unprofitable quickly. Monitor Greek exposures. particularly delta and gamma, to understand how price movements affect your position value. Step 10. Post-expiration strategy. After the short option expires, you're left holding the long option. Evaluate whether to hold the remaining option based on your market outlook, sell it to realize any remaining time value, or use it as part of a new strategy. The long option can serve as portfolio protection or be converted into a different spread strategy. Minimum profit calculation method. To calculate minimum profit scenarios, consider the worst-case profitable outcome. If you paid a $500 net debit for the spread, and the short option expires worthless while the long option retains $600 in value, your minimum profit would be $100 minus transaction costs. Factor in commissions, exchange fees, and bid-ask spreads when calculating realistic profit expectations. Advanced optimization techniques. Consider rolling the short leg forward to the next expiration cycle if the trade is profitable but hasn't reached maximum potential. This technique, called rolling the calendar, can extend the profit period and capture additional time decay. However, it requires careful analysis of implied volatility changes and market conditions, risk considerations, and USA regulatory compliance. Ensure compliance with U.S. cryptocurrency regulations and tax reporting requirements. Calendar spreads are subject to wash sale rules and specific tax treatments. Maintain detailed records of all transactions for IRS reporting purposes. Consider the regulatory status of the exchange and the specific cryptocurrency being traded. The long call calendar spread offers cryptocurrency traders a sophisticated method to profit from time decay and volatility differentials while maintaining limited risk exposure. Success requires careful timing, continuous monitoring, and disciplined risk management throughout the position's life cycle. Please like, subscribe, and comment.